Welcome back, future retirees. This is Dr. Jeff Wilson coming to you from our fabulous Freetirement studio right here in sunny Southern California. So continuing on with our module 1.3, now that we have tallied all of our cash flow, also known as our income and expenses, it's time to move forward towards assets and liabilities. So this step is critical in assessing your situation. In order for us to understand the weaknesses and strengths of our own financial plan, it's important to sit down and critically assess all our current holdings and the liabilities attached to them, right? So, many times when people consider their assets, they give no consideration to the taxation of those assets. We're not going to do that in this exercise. So we're going to be listing our assets and liabilities, and we're also going to talk about how each of these asset classes might actually be worth less after taxes are considered. So in this calculation, we're not just going to consider your net worth. We're going to consider your after-tax net worth. This really is going to help us understand where we want to be and the goals that we're going to be setting. So before we go through listing all of our assets and liabilities, I wanted to take a few minutes to go through an explanation of each of these primary sources. So this is a lot of information, but I want to address the asset and liability classes. Now, it's really beyond the scope of this training video to cover every single asset class and all of their characteristics, but I do want to touch on at least some of the most popular ones and go through some of the misconceptions that people may have about them and some of the key features as well that are something that you should maybe be looking into. So let's go through the asset classes one by one. The most basic form of asset classes would be considered cash and cash equivalents. So this would include cash, the legal tender that would be in your pocket. Now, while cash may no longer be king, checking, savings accounts, money market accounts, anything that's like cash or cash equivalent would be considered a very conservative and liquid investment. Something that, you can easily access on a moment's notice, right? Now, as we're discussing your cash investments, it's important to note that the taxes have already been taken out of that money, right? This is money that you've already earned or received as inheritance, or it's part of your sales proceeds, and it's net of the taxes that have already been paid. Now, if we're considering a security that has appreciated, right, a tax liability or a gain, we're going to discuss that in the next step, which is investment. So, moving forward from cash and equivalents, which don't really have a tax liability unless they earn interest, it would be our investment accounts or investment holdings. Investment is a general term, but we're going to go a little bit more specifically and call these to be securities. We're going to go through non-security assets, and we're going to go through real estate assets as well. But we're going to separate these into securities, which includes stocks and bonds and mutual funds. Now, real quickly, a stock is simply ownership in a particular company, right? Most of us are familiar with what a stock is. It's purchasing equity ownership in a publicly traded company. Now, you could theoretically buy stock in a non-public company, but for the purposes of this exercise, we're going to focus on publicly traded stocks. So, a stock is simply a percentage of ownership of a company. So, if I buy one share of Apple, I own a small portion of the Apple Corporation. And every time they make a profit, I can potentially share in that profit if their stock price increases. Now, stocks, some of them actually have dividends. And dividends are essentially income that the company pays to its shareholders as a portion of the profit that the company earned. Other stocks that are focused more on growth do not release dividends to their stockholders. And instead, their stockholders are holding that equity in order to benefit from the future growth of that company. Now, this is a really good segue for us to talk about different types of stock. So when it comes to stock types, there's a spectrum that classifies stocks by the size of the stock and the type of the investment of the stock. When we're talking about value stocks, think of ExxonMobil or Walmart as opposed to growth stocks, which would be like Nvidia or Tesla. So a growth company, in lieu of focusing on returning dividends and profits from a well-established business model to its shareholders, is instead focused on growth. It's focused on reinvesting all potential income, and there may not even be any income associated in the first place. Maybe it's just capital investment, and the company's actually losing money, but that could still be considered a growth stock. So a blend would be a little bit about both. So if you think about a company like Disney, they have a lot of their legacy business models, such as their theme parks, that are considered more of a value model. And they also have Disney Plus and a lot of the new initiatives that are considered growth models in the company. So if you look at essentially the multiples of what they're trading, their price to earnings ratio, you're going to see they're right in the middle of value and growth companies. Anytime you look at a particular company, you could just categorize it as value or growth based on their PE ratio, which is the price of the stock divided by the earnings of the company. So if you have a high PE ratio, that means you're paying a high price relative to the earnings of that company, which means it's a growth stock. If you have a low PE ratio, that means you're getting value. You're paying a small amount and a small multiple of that company's annual income. Hence, it's a value company, and you expect to generally receive dividends or some sort of a cash flow coming from those type of companies. Now, of course, on the other spectrum is the size of the stock. Small company, medium company, large company. The technical term we use is capitalization or cap. So if you hear small cap, that means a small capitalization company. If typically you just kind of simply look this up, small cap companies tend to be somewhere between 500 million and $2 billion. Okay, so mid cap stocks capitalization would be any company that would lie between, say, $2 billion and $10 billion. And anything above the 10 billion mark, the capitalization mark, that would be considered a large cap company. Now, what do we mean by capitalization? So capitalization is the sum of the entire value of the outstanding shares or equity in a company. You could kind of think of it as the worth of the value of that company. So if Apple has $1 trillion of market capitalization, Apple is worth $1 trillion. If I own 1% of Apple, I wish, I own 1% of $1 trillion business. Now, let's jump into discussing the equity style box. After this, you'll start talking like a pro with stocks here. So when we talk about growth and value, they're not necessarily on opposite sides of the spectrum. You can have a growth company that's also a large cap, or you can have a value company that's a small cap. Now, when we think about stocks and we think about the risks and rewards associated with stocks, it's important to consider a few key factors. First, we want to think about the risks associated with stocks. The risk of a particular stock is essentially the volatility or the movement in the price of that stock. Now, a stock with large peaks and valleys, often rising and falling, is considered more risky. Whereas a stock that's very stable, like perhaps a utility company that doesn't have a lot of growth, but it's stable, right? We would consider that a lower risk stock. Now, why would you invest in stocks? Why would you take on this risk? Well, the potential reward associated with stocks is typically higher than most other assets. Over the long term, stocks have historically provided the highest returns compared to bonds and compared to cash and even compared to real estate. Over a long-term investment horizon, stocks tend to go up in value. Now, that doesn't mean in the short term they won't be very volatile and they won't go down, right? We've seen plenty of stock market crashes, plenty of bear markets where the value of all of the stocks collectively goes down. But over a long-term investment horizon, stocks tend to go up. Now, of course, there are exceptions to the rule, and not every stock is going to go up over time. It's important to do your research, maybe understand the company that you're investing in, understand their financials and their business model, and then have a diversified portfolio. So we'll talk about diversification shortly, but having a diversified portfolio of stocks can help mitigate some of that risk associated with investing in individual stocks. So we've talked a bit about stocks. Now let's talk about bonds. And bonds are another major asset class that many investors consider in their portfolios. Bonds are essentially debt instruments. When you buy a bond, you're essentially lending money to a government or a municipality or a company in exchange for periodic interest payments and the return of the principal amount, which is the face value of the bond, and usually at a very specific maturity date. So bonds are generally considered lower risk compared to their stocks because they are debt obligations and typically have a fixed interest rate and maturity date. Bonds are often used by governments and companies to raise capital for various projects or operations. The interest rate on a bond, also known as the coupon rate, is determined at the time of the bond is issued and remains fixed throughout the life of the bond. The value of a bond can fluctuate based on changes in interest rates and the credit worthiness of the issuer. There are various types of bonds, including government bonds, municipal bonds, corporate bonds, and international bonds. Government bonds are issued by a government and are typically considered very safe investments because they are backed by the government's ability to tax its citizens. Municipal bonds are issued by state and local governments to fund public projects like schools and infrastructure. Corporate bonds are issued by companies to raise capital for various business purposes. International bonds are issued by foreign governments or corporations. When it comes to assessing bonds in your portfolio, it's important to consider factors such as the credit quality of the issuer, the duration or maturity of the bond, and the interest rate environment. So higher credit quality bonds are generally considered lower risk, but they may offer lower returns as well. Bonds with longer maturities are more sensitive to changes in interest rates and may experience greater price fluctuations. Additionally, when interest rates rise, bond prices typically fall and vice versa. So, in summary, stocks and bonds are two primary asset classes that form the foundation of many investment portfolios. Stocks represent ownership in a company and have the potential for higher returns, but also come with higher volatility and risk. Bonds represent debt obligations and are generally considered lower risk, but they may offer lower returns compared to stocks. Balancing your portfolio with a mix of stocks and bonds that align with your risk and tolerance and investment goals is a key aspect of successful long-term investing. This is Dr. Jeff Wilson, hoping you are thriving in life, living well in every moment, and sharing your prosperity with those you love. Cheers to your incredible journey ahead.